Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, May 24th, 2023. It's 11:55 a.m. Eastern Time as I'm starting the video, and I'm going to cover some of the things I'm watching as of right now and this week. Of course, we're getting closer to that debt ceiling deadline with the earliest date where the U.S. could possibly default is June 1st, so a week to go there. And I think we all know we're not going to default. We never have. If anything, maybe a partial shutdown. This one could go down to the wire and probably will, as I said before. We all know it. I don't think there's ever been a point in history that the Democrats and Republicans were more at odds with their policy. So we'll see what happens now. Excuse me. I am feeling a little better today. I think I turned the corner yesterday, but I'm far from peachy. As soon as I'm feeling 100%, I'll start getting some screenshots out and written posts. I know that's easy for a lot of you, especially during the day if you're working or doing other things and watching these videos. But I wanted to cover a few things, quite a few things, and that's a lot easier to do in video format. All right, starting out here with the 10-year Treasury bond. Treasury bond yields TNX. This is a weekly chart, and remember we have this is the monthly chart here. There's our primary, this white line here, primary downtrend line. All the bonds, all the U.S. government bonds, the 30-year, 5-year, 10-year, they all broke that primary downtrend line, and even before that had all the makings of a new uptrend, taking out previous highs. So hard to say where we go today, tomorrow, next week, but to me this looks like a high probability of a secular trend change, meaning interest rates look to probably be heading higher for years, possibly even decades to come. So how it plays out, we'll see. We could certainly come in for a back test of the trend line or not. The level that I would watch, or I am watching right now, is right here. Right there, I have it about 4.5. Let me go to the weekly. It's a little different. About 4.1% on the 10-year. Right there, you can see this support line or resistance line. You have some reactions here. You broke below it, had some reactions there, danced on it quite a bit there, broke below it. When you're below a support or resistance level, or below a support level, it then becomes resistance, and that's what it was. So we hit it recently, and we've been consolidating since. We also had negative divergence at this high right here. And so far, that divergence, you can see it down here, is played out in the form of a correction more in time than in price. I often say a security can correct in one of two ways, in price or time, or a combination thereof. Correction in price, of course, would be a bigger drop, and a correction in time, which is the more bullish of the two, is mostly sideways motion. So either way, watch that. I would give you pretty high degree of confidence that if we clearly pop that level, the stock market's not going to like it. We'll see where we go. We all have our thoughts on, the debt ceiling, what Washington's going to do, where the economy is going. I will acknowledge, I've been trying to read all types of, really burying myself in the headlines, trying to get all differing opinions. I read something from one of the big fund managers at BlackRock, who, he's a Super Bowl right now, and says, where market's going to go up. All these naysayers have got it wrong. Employment's low, and I'll acknowledge that. Unemployment's very low right now. A lot of cash on the sidelines. This is his bullish thesis, and that once the debt ceiling's resolved, that cash is going to go to work. So I'm going to show you right now what my trading plan is. I did that before I left. Told you where my stops would be on the index shorts. There's another trade. I'm going to go over my other trades here in just a second. Ooh, that's my busy board. Let me find a clean board. And okay, this one will work. So, heading off to vacation Thursday before last, it said I'd have stops set, staggered stops, and had two of those taken out, but then told you I'd put, right before I flew home, I put back on one of those lots and increased it since. So I'm back to almost where I was before. Again, I see well, for many reasons. I told you there's a lot of, it looks very indicative of a blow off top here in the market. Let me just fix my divergence lines here. It bugs me when I haven't updated a chart. I have a lot of different boards and I don't look at everyone every day. So this last move on the higher volume, the big candles, and it was and I believe I had predicted that was a likely scenario, very a key level for the powers that be, the market makers, the hedge funds, the the trading desk, to blow out stops. So you never know for sure. Short interest is disseminated comes out twice a month, and it's dated by 12 days by the time it's released. But I will bet very good money that a lot of the final last amount of we'll call them weak-handed shorts. They got me only because I was out of town and wasn't in front of the computer. I might have pulled those stops, as I told you, but I was out flying in helicopters or taking boat tours of the island, and this is most likely a big stop clearing move, especially when you see it after such an extended run, and it's really right. It was right to the top, a hair above my max bounce target zone. So like I said, you get there, that candle blew them out, and now we're back below it. So that is, I'm not going to call it a false breakout. It was a breakout over that previous high by a very small margin in QQQ, but not in the stock market. When you look at every other index, here's QQQQE, the equal weighted, still well below even that peak high, and as well as the one back in August right there. You have the S&P 500 still right about where, it only went a hair above this previous high and still well below that same August high, which was the top on my max bounce target zone for SPY. So my point is, and I said it recently, and I'll just reiterate it, this to me right now, by most metrics, the one that I'm choosing to apply is nothing more than a bear market rally. Time may prove that wrong. And so now my trading plan is this. Now we've reversed. We're going to see probably some, profit taking, rightfully so, leading up to the resolution of the debt ceiling, whatever they do with that. And I think it makes sense now, if you are, short, or you want to short right now, a stop really above those recent highs. We already blew out the that previous high right there blew it out marginally. That was actually right there. I just put the line up where it was. So we took that out by a small amount. And pretty much the market has no business going above there. It's not the end of the world, but it does, as I've been saying for months now. This was my max bounce target zone all along, that purple box. Let me box it in all along, because that is where I figured after the big divergent low back here, that would be the maximum amount this bear market rally might carry. So, nothing's changed my mind for, what is that, going back to October now, or shortly after that for, 6 months or more. Okay, so that's that. And again, I think stops there. You could stagger them if you want, a couple above. I usually do staggered stops. And I'll, when I'm in front of my desk, I'll read the market action, read the tape, they call it, and decide what to do. All right, let's move on. That's what I'm looking at with QQQ. And just to reiterate, this is important. To me, I've been speaking about all along, started shorting back here at the top of the most likely bounce target zone. That's the red box. And I've maintained all along, I always talk in different trades. I'll talk about active trades once in a while when I'm in active trading mode, give you 5-minute charts, 15-minute charts, sometimes cover that, bounce the QQQs or NQs around for 1-2%. These are, and what I've been talking about before, and I'm talking about right now, trend trades. If I am correct and there's going to be another leg down, then I'm talking it's going to be about probably a 30% drop in QQQ. And I know very few can see that right now. There's two things I'm going to promise you. Number one is I'm going to be wrong, and I'm going to be wrong a lot. So do your own thing, use your own stops, go with trades you're comfortable with. Just know that I've done a pretty darn good job calling the bear market up until now, calling big turns, getting covering shorts and going long on or near the bottoms. This one, admittedly, for a trend or swing trade, got in a little too early. But really, from the top of the max bounce target zone, again, that's QQQ, which happened to have an unusual disparity. I think they said, I read an article, this might be the largest outperformance over the Dow from the Nasdaq 100, either in history. Yeah, I think it's since the Nasdaq 100 first came about. And so this is unusual again, and this is not the stock market. I've said that many times. It is my preferred trading proxy because it tends to go up more and fall more. And when you get a lopsided, one-sided crowded trade, the other promise I was going to make to you, and I said there were two, one being wrong. And the other is that the headlines and sentiment will change. If you think there's no way that we can go down 20 years, maybe we'll get a little correction, but we're going to go up. That I give you my word on. If we are going to go down and we are going to hit those longer term targets I have on the weekly chart for QQQ, which, if you're new to the site, these are the targets I had since shortly, either right after this bear market started or shortly before. We were short at the highs there, T1, T2, T3 right there, and then T4 is my next target. And these are really, if we get down there, especially, I will most likely add longer term targets. Now, if we get down there and the charts confirm, that's most likely where I'll be covering shorts. But that is my next target. I had this blue uptrend line and the 235 level. Now we can obviously see it's been a while, so the blue uptrend line comes in first. Let me just measure it out for you. The blue uptrend line, if and when hit, would be about a 20% drop, and the fourth target down to around 235 would be about a 30% drop. So that's why I keep referring to the next leg down if there's going to be a big one, to about a 20 to 30% drop. And it should be relatively, maybe a little bit less in the S&P 500. And small caps may do that, 20, 30%. I'll have to look at those later. All right, couple more things I wanted to show you. I already covered Treasury bonds. Let me just now cover the sectors that I've been highlighting. I always say the stock market's one thing. I always, at any given point in time, will be diversified even in my trading account. Of course, I have long-term accounts. They're even more diversified. I don't trade them as actively, IRAs and such. In my trading account, I'll trade different sectors, different asset classes, stocks, bonds, crypto. And so one that I've been harping on for quite a while now is the semis. I didn't mean to load a weekly chart, but I was just on that for QQQ, so we'll just go here. Same with the semis. This was a divergent high, and I laid out these targets way back when. T2 created that back in February 1st of 2022. So remember, that's right when pretty much the market and the semis peaked. We had my first target there. We had a nice tradable bounce, double-digit bounce. Dropped down a little more. I labeled this as S1R1 back on that time too. S1R1 means support, first support level / first resistance level. So it was, as you can see, it was support here. So that, you were able to gain a bounce off that support. And then we broke it. Support once broken becomes resistance. Boom, 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 boom. That's 3 weeks. Each boom is a candle. Boom, 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 boom. There we are now. So again, I'm sure there are some out there undoubtedly who are frustrated. If you took this trade, been short the semis for quite a while. I'm still considering that I was early, not wrong. There's a distinction between being early and wrong in trading, in my opinion. Early, just get into something and it takes a little bit longer or a lot longer to play out, as long as you're not stopped out for a loss. And that's when you're wrong. If you are, the security goes up above any reasonable, or your loss, your stop loss. Excuse me. Okay, so that is the semis. There it is. We had a divergent high there, marginal new, still divergent high, marginal new just recently. And I mean, I don't even know if it was, it was almost exactly where we were back here in April. And I pointed out, these levels as objective shorting entries. And there's T1, T2, which have already been hit. So I still think we're going down, and I still maintain these targets as of now. But same thing. That's really, at this point, it is going to be hard to say, because when there is a resolution of the debt ceiling, I have to imagine there's going to be at least a very initial pop in the market. Could be substantial. One thing I'll say about this with stops, you can put a stop, and if it is a debt ceiling resolution that pops everything just over here, and then we drop down, we start moving lower, you can always re-enter. The thing about trading is you just can't let your losses run. Maybe it's the real deal if we pop that level and we keep running up, and then sooner than later, if we keep rising, all these divergence lines that I keep extending out and dragging, well, they may start getting burned through. And then my long-term indicators, which I covered yesterday, PPO histograms and 20-month exponential and simple moving averages and all the others, they start to change. And at that point, you're really clutching at straws to try to make a case, that we're still in a bear market. And even then, so my point is, you stop out, and then if you fall back down through there and it proves to be a whipsaw, you can always get back in. So that's my point. All right. Now, when you look at the semis, a lot of this has to do, the semis are starting to get a little top heavy, kind of like the Nasdaq 100. So when you really look at a breakdown, this was the proxy I used for that trade. There's other semiconductor ETFs like SMH, XSD, but SOXX is the one that I typically trade. When you look at it, most of this has been attributed to NVIDIA. I don't know what their weighting is in the ETF, but I'm looking to the side of the monitor. You can't see now. I'm looking at the market cap, and in this ETF, SOXX, NVIDIA is the largest cap weighted by far. It's a $767 billion company. The next largest is Taiwan Semi at 475, and it goes down sharply from there. Broadcom, which is AVGO, 283 billion, ASML 275. So where I'm going, a lot like the Nasdaq 100, there has been significant breadth deterioration in almost a false guise of strength in the semiconductors based on the weightings of just a few stocks. NVIDIA has been, a big, it's the best in show, best in class, best in show in the semis, AI beneficiary and all that stuff. But it still has big divergence, and I think its day is coming very soon. And I'll also maintain, I think the top is in. We'll see if my little vacation indicator pans out or not. But I think the top was pretty much has just been put in the market. Now, here's what I'm going to do. I'm going to rifle through all these real quick so you can see NVIDIA. Just pay attention to the recent price action. So when you see there's Taiwan Semi, you can see Taiwan Semi, unlike NVIDIA and so many others, is in a downtrend and has long since peaked and is not going up. With the market. Broadcom doing great. Give it props. Here's a big trading range. This was a technically induced breakout, a lot like the Nasdaq 100 recently. It broke out of its trading range and popped up. So great if it can hold this level, but if it falls back below and goes into that trading range, that's a failed breakout. If it falls down below the trading range, I think it's lights out, and I still maintain all these targets on Broadcom. ASML going nowhere. It's still in its trading range. That box right there. In fact, it just had I put a line right here. It popped the range once right there and popped it again, but it fell back into it now. There's a little trend line to break. But again, this is a stock that peaked back in February, another big semi. This one's climbing a little bit more over that previous high, but still negative divergence. So I'm going to sound like a broken record as I go through these. Negative divergence on almost all of them, and some of them the divergence has already played out. So I'm going in order of market cap as I do this. So you looked at a couple of the leaders, which were the top weighted. And I'm sure they're the top weighted in the ETF, I'd imagine, because their market cap's largest. But you can see a lot of the semis have peaked. And these divergences, sometimes they take a while to play out. Sometimes you get a divergent high and you have another marginal new high. And there's Texas Instrument. And this is big support right here, big support. So that's the level which will be lights out for Texas Instruments if and when taken out. Intel, dead money for what, a year now almost. Broke out of its trading range back, here and here. This was one of my favorite longs, and we milked it up, but then got out at T2, and that was it. Had a breakout, proved to be a false breakout, and fell back into the range. And so usually when you do that, the next stop is the bottom of the range. Qualcomm just broke and made a new 52-week / multi-year low today. So this one's not looking so good. This used to be one of the leaders in the chip industry. So that's what I'm trying to do, is just show you those that have been strong and have recently put in new highs. Just about, if not every single one, did it with divergence, negative divergence. And I'm seeing more and more failed breakouts. This was, you can see my purple box here, traded pretty well-defined trading range. We popped it on that same short, what I call, a blow-off top recently, a near-term or longer-term blow-off top in the Nasdaq, in the chips. And, obviously the chips are part of the tech sector. And you can see that breakout has failed. Okay, there's another one, divergent high, ADI, and it's moving lower since. It's at pretty good support right now, 170.24. So if it breaks that level, my next stop is 159.85. Okay, I can't go over each and every one because there's a lot in there. But you can see when you get down to the lower tier, lower market caps, you can see a lot of these semis are lagging behind and are not doing as well, especially in recent months. So again, like the Nasdaq 100, it's just a handful of the larger market cap weighted stocks that are doing most of the heavy lifting. Okay, another sector that I highlighted for you recently is a trade idea. And of course, I've gone over a lot of these sectors in detail, so you can, outperform a sector by whether, if you're bullish on the sector, go with the most bullish looking stocks individually and ignore those that either have an indeterminable chart or a more bearish chart. Or you can go with the ETFs. ETFs obviously have benefits in being simple, one and done, diversification, but the downside is you can usually do better if you go over that. IAI, broker dealer index, still in a precarious technical posture right now. It has this support level about 85 right here, that if it breaks, which sector doesn't look so hot to me, we're probably going to head down lower. And it's also one to keep an eye on. That's in my that list I told you I put together recently of things to watch, because that's going to spell trouble in Financialville. All right, everybody's still watching the regional banks, and I'm watching everything else because that's old news. All eyes are on the regional banks, and I'm still keeping an eye on those. Don't get me wrong, but I'm also looking out for other potential cracks in the system. So that's one of them, and I do think there's more downside to come. But I'll acknowledge this. You can see I have some positive divergence here. So let's see if that divergence plays out or not. Next up, another sector was PSP, kind of moving sideways, at least the ETF. This is the private equity ETF, holding private equity companies like Blackstone and KKR. Hit our second target, came close to our third, and I'm still figuring another leg down, still maintaining those targets. And then I wanted to do an update on GDX. This was another one a little early on recently. I've been calling it like a fiddle until right here, got out a little early, even though I had that T4 originally, for target from really back here, but we put in this divergent high, and there's an example of a divergent high that didn't take too long to play out. You had a trend line break right there. You got the initial sell signal, pushed up, made a marginal new and divergent high right into resistance. Gotta love those strong rallies into resistance with negative divergence. I just covered, I was going to reverse and go long, covered this short today, but I with everything going on and the whole debt ceiling thing coming up, I think it's a good time to lighten up. I wouldn't be going crazy long, crazy short. My guess is we'll probably bounce here soon. Let me show you gold and silver. Gold, see, I just don't have gold. I don't have any really well-defined support levels on GLD. It did put in that divergent high, and based on the scope of those divergences, it could take a little longer to play out. But on this, I'll give it points. This is the PPO 0 line right here that I just put that white line on. And typically when you're above it, you're in a bullish trend. And quite often you can come back and you back test the line. So you can see the PPO line is back testing right now. And that could be it. You know, gold's had a pretty strong bid most of the year. This is going to be the big level when this breaks out. That's a major resistance. If you flip to the weekly chart, I'm going to extend this line. That was our last bull market high in gold. We came up, tested it once, and ultimately, I think we do go on to break out. I'm just not sure when that's going to happen right now. So, you know, probably going to get a bounce here sooner or later. I don't have positive divergence right now on the 60-minute chart of gold, although I believe I do on silver. Yep, so silver's right here. You can see some 60-minute divergence, but at the end of the day, silver's usually going to follow its big brother gold. Silver could walk down here and still have that divergence. And that's even, see, silver's in no man's land. It's between support, which is about $21, and resistance, which is about $21.50. So I might be a buyer of silver right here, and then maybe GTX, because that's pretty decent support. Let me show you what it looks like on the daily. We're a little bit below that trend line we back tested. And then the big driver is going to be the euro US dollar. And this is why, again, probably a good time to keep it somewhat light in the dollar sensitive assets, because what happens going forward with the debt ceiling and everything else has a potential to impact the US dollar. You know, the current administration wants to spend, give money away, print, tax and wealthy policies that aren't going to be good for the US dollar. Our debt is spiraling, and like everything else, it's just like, you know, think of the debt for the US, just like the inflation trade that finally came to be. The Fed figured, you know, they started going to a zero interest rate policy and doing quantitative easing and flooding the system with money back in 2008 to stave off the financial crisis. And then every time there was a little hiccup, they did more and more, and they thought, well, you know what, we can just keep printing money and we're not seeing inflation. So they just did it until finally one day inflation did rear its ugly head. So there will be a flashpoint at some point with the U.S. Debt or deficit. But anyway, that where I'm going with that is it's going to affect the dollar. We're still at support right here in the euro U.S. dollar pair. I told you yesterday, I think based on the scope of these divergences, there's probably going to be more downside, but we're at support right now. So that's where I'm thinking maybe a bounce. I don't have strong convictions. If I did, I'd tell you, and I'm trying to do as good a job at doing that. Okay, my chart's locked up there for a second. Here we go. So you do have some divergence. I jumped down to a 60-minute chart, and you can probably even draw a trend line there. Yeah, that would be our downtrend line. So there's some divergence now, which indicates there's a decent chance of a bounce off there. Remember, the euro US dollar pair is really pretty much the dollar in reverse, and so gold and silver move up and down with this. This is not mere coincidence. And that played a big factor in the recent short on gold, silver, and GDX, is that expected this move down in the euro, and that's exactly, you can see, all right, so that was May, we peaked there on May 4th, and here's GLD, and took a little bit longer, but then finally started to fall. Silver right there, peaked out on April 13th. What was that? EUR USD. Yeah, there was a little bit of a lag there. That's right, May 3rd, May 4th. But it played out. And once the market realized this wasn't just a normal zig and zag, once we started going out, and that's really, you can see we took out that support right there. And more importantly, it was a sell signal. There was the breakdown. So we were going up this trend line, and that's when, and I did an update right before I left, we were just cracking that. And so the sell signal right there The break of that big wedge came on May 11th, and so that's probably a better way to go here. And there's the top in gold was on May 4th, and by May 11th they got the memo. May 11th was right there, and then gold started moving down, and silver, of course, and GDX. So all right, guys, so that's it. That may be all we're going to get for the pullback in gold and silver. I'm just not sure. And again, it's a wild card right now with what's going on in DC. So maybe stand aside that trade for a while. Or if you're in it, long or short, just use stops and let it run. Okay, I'm going to wrap the video up here. On the 1 minute chart, I can see we're getting a spike up in the futures and the indexes, QQ and all that. Looks, from the looks of it, don't have the TV on. It looks news induced, but I think if you want my best guess, here's a trend line. This is a 6 month chart with 2 hour candles at NQ, Nasdaq 100 futures, and this is the pretty decent trend line. And the free actions to validate it. And I think at minimum, we're probably coming down to there. And that would also be a back test of the top of the recent range. So remember, this was a breakout back test right here. Oops, I botched that up. Show it one more time. So we had the breakout and a back test, and we moved on up. And then this is what appears to me to be a buying climax, aka blow off top. There's what it looks like. There's one right there. And so I think at minimum we come back to test that. Now, if we do, this is where the bulls, if you are bullish and long, you want to see the buyers step in there. And then, of course, you want to see them take out those previous highs by a fair margin, like I said before. Not just marginally, but farther they get away from that level, the better the odds are we're just going to keep going up for a while. And then if you are bearish or looking to short or get short or add to shorts, then a break back down below there would be pretty powerful. That means this whole thing would be a false breakout. That's 13,355, and you can go to the comparable level on QQQ. You can see the trading range on QQQ, and then a move down there. You can see the levels. I marked this chart up today. These are, to me, the significant levels: 13,355, 12,924, and 12,580. I think those levels, if and as each are broken, are going to increase the odds that we're going to go much lower. And those will be levels that I think tactically you can add on to short positions. And pretty much at this point, if you are of the same mindset as me and we're going to have another 20 to 30%, possibly plus downside, then at that point, you could take it to a full position, whatever your definition of a full position is. I'm not saying put your whole portfolio short. That would be not prudent risk management. But, you know, if you're going to be X amount short the Nasdaq 100, then that's where I think would be your full all-in moment right there. And then again, stops are always relative to one's price target. So if you are looking at a 30% downside, and let's say you added, if you added there, your average cost is going to be up here if you're, shorting now. So, on a 30% downside, I can't even go above the screen. You could easily use even if you had your stops a little bit above there, that's only going to be about an 8% stop loss. You still have a very attractive risk-reward ratio. All right, guys, I'm going to wrap it up here. Still not feeling so hot, and I'm going to get this video out to you and keep hunting for new trade ideas, and I'm continuing to keep a close eye on those things to watch or any potential cracks or strengthening. I'm looking at economic indicators. I'm watching a lot right now, and I know a case can be made either way, bullish or bearish, and I'm doing my best to keep my opinion, my views open, and ready to change tunes, and then start maybe getting some long ideas out to you if it looks like we're going to have a good rally. I'm just finding a hard time coming across any bullish setups now, and I haven't been able to dig into the charts as much as I wanted to when I got back due to the illness that I'm dealing with right now. Okay, guys, I'm going to wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a good day.